now we're going to look at calculating net present value with uneven cash flows. So we have an example. The initial investment for each one of these projects is $12,000. Now when you're setting up the tables in Excel, you want to make the initial or year zero investment a negative number. This will help you in the future. We have 3 different possibilities for this $12,000 cash investment that we have. They each have a total cash outflow or cash inflows of $15,000. But project A has even amounts that it's going to have cash inflows. Project B and project C have uneven amounts. So when we're looking at the tables, when we have uneven cash flows, we want to go to a table that is the present value of a lump sum. And we need to take each year into consideration, 1 year at a time. So we have 10% for year 1 is 0.909. So I'm going to put that factor over here. So 10% at year 1, 0.90909. And then 10% for year 2, 0.82645. And for year 3, 0.75131. So remember, when you have different values in each year, you need to go to the present value of a dollar table. When you have the same exact annual cash flows every single year, you can go to the present value of an annuity. So when we're looking at this, we want to take each amount of cash flows times our factor in order to discount it back. So we're going to take 5,000 times 909. We're going to do this for each project for each year so that we can get the present value of cash flows discounted back. And then we're going to try to evaluate which one of these projects is the better option. So we take the sum of our rows to calculate which one of these has positive net present value. So the net present value of each project is shown here. So for project 1, or A, we have a net present value of $434. For project B, we have a net present value of $908, and project C has a negative net present value. So when we look at these 3 projects, we know that project B is the best choice, looking at the net present value calculations. Actually, before I move on, I'm going to show you one other way to calculate net present value in Excel. So what you can do is Excel has a net present value function. You take the equals NPV, you select the rate, and then you want the values. It's going to give you a slightly different number because it's calculating much farther out than just the couple of numbers that we went on our factor. But you can calculate the net present value. So if we want to look at the net present value, we're going to select the rate. Then we can take these values add the $12,000 investment, or not, need a comma. So that's another way to calculate the net present value using Excel. Now we're going to look at replacing assets. So we have different capital investment decisions. What we were looking at before was, do we want to just purchase a new one without taking into consideration if we want to replace existing assets? So these have a lot of the same decision factors that we need. We need our incremental analysis. So when we're looking at that incremental analysis, remember incremental is the change or the difference between the two options. So what are the improved cash flows or changes from choosing that replacement equipment? What's our discounted cash flows if we're using a required rate of return? Are there any income tax effects by having better depreciation expense or other things that affect our income tax amounts? And what are the non-financial factors in making that decision? So we have this example back to the baseball company where we're looking at the option of buying a new bus. So we have a bus, it's old, it doesn't have air conditioning, it needs a lot of repairs, and we found a new bus that does have air conditioning and is more fuel efficient. So we're looking at our different options. The new bus costs $65,000. We currently have a book value of $25,000 on our existing bus, but it has a sales value of $10,000. So we're going to take a loss on that sale. We have annual operating costs for the new bus of $18,000 a year, and our existing bus costs us $30,000 a year. Now, we might look at this table and think that it's a no-brainer that we're going to replace the bus because the existing bus cost us so much money in repairs. But we're going to do the analysis. First, we have to look at the sunk costs. So what are the sunk costs? Well, the money that we already spent for the bus is a sunk cost. Okay, so the cost of the old bus is not relevant to our decision. And so we're not going to factor that in, even though that $15,000 loss doesn't look like a good thing. The potential savings in maintenance costs might outweigh that. So we're going to look at the incremental cash flows. So we're supposed to produce an estimated of $12,000 annual savings in operating costs. So that's the difference between that $30,000 in costs and $18,000 in costs. So if we're currently spending $30,000 to maintain the old bus, we're going to save $12,000. We're also going to have depreciation. So we're going to have an increase in our depreciation, which lowers our tax liability. So that increase in depreciation means that purchasing the new bus increases taxable income by $4,000 per year. So we have additional depreciation expense and we have tax consequences. So we're going to look at this example. If we have a 40% tax rate, then purchase of the new bus increases our annual income tax by $1,600 because we have increased expenses Therefore, when we look at our incremental cash flows, that savings, that $12,000 savings in operating costs, less the $1,600 in additional income taxes, then our new cash inflows are $10,400. We're going to discount that back using our discount rate. So we see that the present value of those cash flows, $34,861. We also have the proceeds from the sale of the old bus of $10,000. Then we have tax savings from that $15,000 loss on disposal, because that's going to come off of our taxes. We have a total present value of $50,081, less the cost of the new bus. Well, that gives us a negative net present value. And as I already said before, anything with a negative net present value does not meet our required minimum rate of return on capital investments, and we would reject that decision. When we're looking at those non-financial considerations, should we just reject it because it has a negative net present value? Are there intrinsic non-financial benefits from maybe having air conditioning or a vehicle with better reliability? It's possible. We also need to consider that capital budgeting proposals occur over a great number of years. So we have to get a lot of input from different individuals. It's not just making a decision based on financial factors, but we have to cover other things. One is, what are our limitations on taking on capital investments? Do we have a certain amount each year that we're allowed to spend? And so that makes us rate capital investments differently. Do we have an unlimited budget in which we can pursue options? Do we have a failure rate at which we cut them off? So we say we estimate that taking on an entirely new product line is going to cost us this big capital investment in new machinery and stuff like that, but we predict that taking on that product line is going to make us a lot of money. However, what happens if we get into that new product line and our predictions were wrong, we were overly optimistic, and it ends up being a total failure and we don't recoup any of our money? That's an unknown that we go into a capital investment with. We can't guarantee that our projections are correct. We're making the best estimates we can on the information that we have, but it is a gamble sometimes to go into these investments. How we track them then is called capital budget auditing. We make a list of our projected expenditures and projected inflows, and then when we get into the project, we look at those as compared to the actual expenses. We also generally say that we should, in that 5-year period, we should progress at a certain rate. So if we're going to take on this 5-year period where we're going to have this piece of equipment, we want that project to be sustainable in 3 years, we might say. And so when we're looking at these audits, we would look at, are we actually on track to make our investment back in 3 years? Are we behind schedule? Are we ahead of schedule? And why or why not? So this comes into budget variance analysis, but specifically with capital budgeting. So as I said before, we can use Excel to calculate net present value. We can also use it to calculate the internal rate of return. And what the internal rate of return is on a project is that it's the rate at what makes the project come out to zero, the net present value come out to zero. So if I say that my minimum rate of return is 12%, as we can see on this example, and if it's a positive value, that means the rate of return on the project is higher than 12%. what that internal rate of return then will tell you the exact percentage that that investment is actually giving you. So if we set up our Excel table, that we have our cash flows, as I said, you want your initial cash flow to be a negative number. And then this project lasts 8 years. And we have outflows, or we have cash inflows then we can determine what is the net present value, our rate, our flows, and then that amount plus the initial investment. This only works if your initial investment is a negative amount. So that tells us that we have a positive net present value for this project. So we know that the required rate of return of 12% is being met, but we don't necessarily know what the rate of return is on this project. So that's where the internal rate of return calculation, for that calculation, you just take all of your cash flows, including the first one. Again, it has to be at a negative amount. This should be a percentage. So this tells us that the actual rate of return on this project is roughly 14.5%, which covers more than enough of our 12%